Allan Gray is a well-known fund manager in South Africa. He has an illustrious record in performing for clients and managing clients' money for the long term. This is Uncle Kevin here. Welcome to my channel as I interview fund managers in South Africa to bring you the latest investment insights and how to invest for success. And I have the pleasure of having Cedrick Pila, Regional Manager for Johannesburg at Allan Gray, joining us today. So Cedrick, how are you doing?
Fine, thank you, Kevin, and thank you so much for having me. I hope you're well.
Yes, good, thank you. Can you tell us who is Allan Gray? How did it all start?
Yeah, sure thing, Kevin. I hope you don't mind me sharing my screen to also illustrate some of these points.
Okay, go ahead.
Allan Gray is a privately owned investment management firm founded by the late Dr. Allan Gray. So as the name suggests, we were named after our founder.
Yeah.
If you want to have a bit of a better insight into the road to where we are today, this timeline suggests and shows you exactly the different milestones that we've reached. And Allan, who founded the company, was born actually in East London in South Africa. So he's a South African. He studied at Rose University, and after qualifying as a chartered accountant, he went on to work at Fidelity Management and Research in Boston and the USA. He also did his MBA at Harvard Business School as well. But he saw an opportunity to come back home in 1973 when he returned to South Africa to establish what would become Allan Gray Limited. And Kevin, in addition to Allan Gray Limited, he set up our now offshore partner, Orbis Investment Management, in 1989 to focus specifically on global investing as well. So we are a privately owned investment management firm that has been founded in South Africa, but we also have a global footprint.
Allan Gray certainly was well known during his time. The history of Allan Gray from the beginning and now employing so many people. When I remember when I went down to Cape Town to attend an Allan Gray seminar, and was a quite impressive building at Waterfront, employing a lot of people, and actually have done great work in training the young people and get them up and running in the financial service industry. Cedrick, my next question is, what makes Allan Gray different from its competitors? What makes Allan Gray stand out?
Yeah, sure, Kevin. It's funny you mentioned the Cape Town office because my background is the Cape Town office. And even though I'm in Johannesburg and I'm based there, I love visiting the office as well. It's a beautiful office to be in, and it's a really, really nice location. But to answer the question, what makes us different? I think three things that I want to highlight, Kevin, is firstly, our ownership. So we are a privately owned investment management firm. So we are not listed on any specific exchanges where you can purchase shares in Allan Gray, but a controlling interest in Allan Gray is actually held by the Allan and Jill Gray Foundation, which in itself has no owners in the traditional sense. Instead, it was a foundation and a vehicle designed to ensure two things. One, that we continue to promote the commercial success and continuity and the independence of Allan Gray as an investment management firm. But secondly, to ensure that the profits that are made from the Allan Gray businesses go back into philanthropy through the foundation, because we also believe strongly in being able to make a change in the communities in which we operate. The second thing, Kevin, that makes us different is we have a global expertise. I alluded to Orbis Investment Management, and I'm sure we'll speak a little bit more about them but later. But our headquarters of Allan Gray are in Cape Town, the office that you love so much. But we have offices all across Africa. We also have an affiliate office in Australia. Our offshore partner, Orbis, is based in different offices all around the world. But we share a common founder. We share a common investment philosophy and common values. So that's the second thing. And then the last thing that I'll touch on that makes us different is our investment philosophy. And I know you've probably seen the slide many times yourself, Kevin, but it's very important because it's the heart of what we do, right? It is, our investment philosophy makes us who we are, and it stayed the same virtually since 1974 when we were founded. And we put all our energy and resources into, firstly, researching intrinsic values of companies. So we want to know what is the true value of a business, and we put all our energy and effort into doing that. And once we have an idea of that, we overlay that and look at, well, based on our assessment of a business's intrinsic value, what is the share price of that specific business? We then have a look to see where the share price lies in relation and relative to that intrinsic value that we've calculated. Again, I want to stress that we've done this since 1974. The philosophy in terms of how we do business and how we want to assess the viability of businesses hasn't changed. Is we firstly focus on intrinsic value, and then secondly try and have a look of those businesses and of that intrinsic value, where does the share price actually sit before we make any decisions to buy or sell a specific company. That's brilliant.
Cedrick, I must say that the first time I saw this from Allan Gray was back in 2002. At that time, I was working for my previous employer, and I was one of the trustees of the staff pension fund. And we invited a few fund managers to come to do presentation, as we were to pick one for managing market-linked funds. And Allan Gray, one of the presenters at the time, just showed this graph. And yeah, it stuck with me over the years.
Yeah, no, I mean, 2000, back in 2000, I think that's 21 years later, the slide hasn't changed, right? I'm sure you can attest to the fact that the slide hasn't changed, and the way in which we do business hasn't changed either. And if I think about it, Kevin, one of the things around buying shares, and I'm sure you've seen in your tenure in the industry, is there are different points in time where you can buy shares. And, you know, clients without any knowledge about stock markets tend to just follow whether something is done well or it hasn't, you know, and don't really pay too much attention to price. But we try and ensure that we purchase a share at a specific point in time where it's trading below our estimate of intrinsic value. And as that share goes up in value, because we try and also make sure we invest in good businesses that have potential for growth, once that share comes to a point where it's above our estimate of intrinsic value, that's when we sell it. And I know there has been a bit of criticism, and people would say, well, you know, based on the graph, why wouldn't you wait a little bit longer to sell the share when it gets to its peak? But the reality is nobody knows when that is. And you could hold on for a little bit longer, but you would miss that peak. And essentially, that's how you lose clients' money, is when you're trying to time the market. So I think this philosophy that you're talking about, that you first heard in 2000, Dr. Allan Gray and our investment team throughout the years have always seen it as something that's been valuable and has helped us create long-term wealth for clients, which is what we're all about and what we aim to do in our business.
Cedrick, I must say this chart is simple in its concept. In reality, it's quite difficult to implement or to carry out. I mean, how do you value a share? How would someone have the discipline to actually do it from time to time, no matter what the market cycle is? I think that's a real challenge for investors. But Allan Gray has done it over the long term. And I think also you mentioned about timing. I think it's extremely difficult, if not possible, to time the market. You know, like everyone, I think all the investors, including myself, we all try to say, okay, what if it goes up more, then I can sell it higher for more profit. But reality is that no one can actually time where the top is going to be and where the bottom is going to be. It's really, it's like as good as like throwing a dart in a dartboard.
True.
You mentioned about Allan Gray and Orbis, and Orbis is a sister company based in Bermuda. And I understand that Allan Gray and Orbis has a range of funds. Can you unpack for us?
Sure. Of course, as an investment manager, the vehicle that we use to invest clients' money is unit trust funds. And those are collective investment schemes where clients that have similar objectives, similar risk profiles, and are looking to invest in something that is aligned to similar goals would pool their money into that collective investment scheme or unit trust fund. And we manage a range of unit trust funds locally and globally through our offshore partner Orbis. On the local side, I'll take you through the 4 flagship funds that we manage at Allan Gray locally. The Allan Gray Equity Fund being the first. And the Allan Gray Equity Fund, as the name suggests, invests in shares, in equity. It does not aim to invest in any other asset class. So it really aims to create long-term wealth for clients through investing in shares that are listed on the Johannesburg Stock Exchange, but also has the ability to take a percentage of clients' money and invest that offshore through Orbis in global equities outside of South Africa. And this specific fund, one would see it as a high-risk fund or high-risk, high-reward fund, but it is really for long-term investing and for clients that seek solely equity exposure. We then have the Allan Gray Balanced Fund, and the Allan Gray Balanced Fund is a multi-asset fund. And what that means is not only does it invest clients' money in equities or shares, but it also invests clients' money in other assets such as bonds, cash, commodities, and properties, both locally and abroad. And the Balanced Fund, as the name suggests, is a bit more balanced than the equity fund. The returns are less volatile. And because you have exposure to other asset classes, your returns are slightly smoother than what you would experience in an equity fund. And this fund is really more suitable for clients, again, who have a long-term investment horizon, but they seek steady long-term capital growth that is not as volatile as the Allan Gray Equity Fund. The Allan Gray Balanced Fund is also one of our more popular funds at Allan Gray throughout the years. We then have the Allan Gray Stable Fund, and the easiest way to explain the Allan Gray Stable Fund is that similarly to the Balanced Fund, it is also a multi-asset fund, but it takes on much less equity exposure. So in the Allan Gray Balanced Fund, we can invest up to 75% of the fund's money in shares, whereas the Stable Fund can only invest up to 40%. That means that it is more suitable for clients that do not want to experience the volatility associated with a high equity portfolio, and they want more stable returns and capital growth. So the majority of clients' money invested in this portfolio won't be in shares. Instead, it'll be in other asset classes such as cash, bonds, commodities, and property investments. And then lastly, the Allan Gray Money Market Fund is the fourth of our flagship funds. And the Allan Gray Money Market Fund, as the name suggests, only invests clients' money in cash instruments. And it is really a parking space for clients and that don't want to leave the money here for long periods of time. And I'm sure you've seen, Kevin, how many clients during this period of time that we find ourselves in the economy have fled these three other portfolio types into cash. Yeah. And really, money market fund is as good as having money in the bank and just earning interest. It is not a vehicle for long-term growth, but we do offer it for clients that have shorter investment horizons, that do not want any volatility or fluctuation in market value. They only care about getting a specific rate of interest. And these are the four flagship portfolios that we have locally at Allan Gray. I can chat a bit more about some of the ones that we have or that Orbis manages globally. We do have other portfolios other than these four, but these are the ones that are mostly suitable for the majority of clients. Right. We do have rand-denominated offshore unit trust funds, but I thought, for the sake of simplicity, let me chat about these four specifically locally.
If I look at these funds and based on your explanation, would you say that maybe if it's a young person, maybe in their 20s or 30s, and they like to invest money for growth, and they do have the time horizon to invest for the next 10, 20 years, maybe equity fund or balance fund is more suitable for them given where they are at their life stage. Whereas if someone is in their 50s and 60s and maybe they're already retired, they start to withdraw from the retirement capital from their fund, maybe a stable fund will be more suited to that kind of investor where they want kind of a more stability of their capital. They will still want some growth, but they don't want to subject their retirement money or in the equity space. Is that how you could interpret it?
Definitely, Kevin. I think you've given a very good explanation of the types of investors that these different funds may be suitable for. So instead of adding, I think you adding on to what you've said, you're definitely correct in the way that you're explaining it. If we have a look at offshore and we have a look at Orbis Investment Management, our global investment partner, they also manage different unit trust funds and portfolios. And the structure of them is predominantly similar to what we have locally, although because there are other regulations outside of South Africa that they also need to meet, they may have different acronyms or names associated to them, but that's not something we'll get into at the moment. The Orbis Global Equity Fund, as the name suggests, invests solely in shares. Unlike the Allan Gray Equity Fund that has the majority of clients' money invested locally on shares listed on the Johannesburg Stock Exchange, the Orbis Global Equity Fund has an opportunity set that is much more broader because it's global. So it can invest in shares that are listed on multiple exchanges all over the world. And if you think about the opportunity set there and the number of opportunities that are available to you, the Orbis Global Equity Fund captures more of that. However, it also invests in shares. It only invests in shares, and it is suitable for clients that can stomach the volatility of being invested in shares. And of course, as you suggested earlier, Kevin, this type of portfolio is usually for clients that have longer term investment horizons. So someone who's quite younger, wanting to have long-term growth in their portfolio, and not suitable for someone that has a short investment horizon. The other portfolios that Orbis manages is the Orbis Global Balanced Fund. Again, some similarities here. The Orbis Global Balanced Fund is a multi-asset fund. Unlike the Allan Gray Balanced Fund that has the majority of its money invested in South Africa, the Orbis Global Balanced Fund can invest in different asset classes, but all over the world. So shares, properties, commodities, cash and bonds in economies other than just South Africa. It has the opportunity set to invest more broadly. And again, this is more suitable for clients that want long-term growth, can stomach volatility, but not as much as the Orbis Global Equity Fund. We then have the Orbis Emerging Markets Equity Fund. And this is a portfolio that predominantly focuses on what is classified as emerging market economies. So this would exclude the United States of America, for example. It would exclude the United Kingdom. And it would be emerging market economies such as those in China, in Africa, and in other countries in Europe that are not deemed developed markets. And this is for clients that are looking for exposure exclusively to emerging markets and the growth and the returns that emerging markets are able to provide. And then the last one I'll share about that Orbis manages on their side is the Orbis Optimal SA Fund. Again, this is not an exhaustive list, but these are the flagship portfolios that Orbis manages. And the Optimal SA Fund is a fund that also seeks capital appreciation. However, it seeks to decrease the risk and the correlation with equity markets while giving you returns that are higher than cash. So this specific portfolio, I know many clients find it difficult to wrap their heads around, but really what it's trying to do is it's trying to de-risk and at least disassociate the risks that are inherent in markets, in share markets, but give you returns that are higher than cash using different strategies that are not as common as those with regards to the Orbis Global Equity or Emerging Markets Equity Funds.
Cedrick, I would say that to me, maybe some clients out there, certainly I think that Orbis funds seem to be more attractive because that you are tapping into the world market. You have a lot of markets you can invest in, a lot of opportunities. Whereas if you just invest locally, you are so limited. What's your view on investing more offshore rather than investing locally?
Sure, Kevin. I think many of our viewers will probably share your sentiments. And personally, I don't disagree with them. The opportunity set and the investment universe globally is much broader than what is available locally. One thing, though, that we can never discount is that we live in South Africa. We understand South African companies because we are customers to them a lot. We consume their products and we also utilize their services. So it is much more understandable for the layman who's investing to know a company that they're investing in based on them actually being a consumer. And things are closer to home and there maybe is a little bit more trust because you understand it a bit more. But the thing that we also are aware of at Allan Gray is the global opportunity set is there. Therefore, in the Allan Gray Equity Fund, in the Allan Gray Balanced Fund, and the Allan Gray Stable Fund, we leverage off the capacity to take money offshore by investing some of that money through Orbis in global economies. So to answer your question, I guess, is you are correct. And that is why we also have some offshore exposure in our local funds to take advantage of global opportunities that are out there.
Mm. Cedrick, you have an excellent point, because that here we're in South Africa, and we have the home advantage, understanding our market, understanding the companies listed on the JSE. So for example, everyone knows Standard Bank, but if you mention JP Morgan, maybe a lot less people in South Africa would say, huh, who? So yeah, excellent point. The next question that I have here is that from time to time, investors receive emails from fund managers asking them to vote on a change to the mandate or investment policy. What does it mean? And when does that kind of ballot or voting happen?
Sure. And this is something that happens quite a bit, not as often as what most people would think. And of course, it shouldn't be something that happens often, but from time to time, there does come a need to change either the mandate of a portfolio, the name of a portfolio, the objective, the fee, because things don't always stay the same and things change. And as a portfolio manager that has a portfolio that you're managing, you need to be able to adapt it for the client in their best interests. And to kind of give you an example of one of the things we've done where we had to send a ballot out to clients is when we proposed a name change of one of our funds. So we were planning to make changes to one of our rand-denominated offshore funds. The name of the fund was the Allan Gray Orbis Global Fund of Funds, but the mandate of the fund started to change, and we saw an opportunity, especially after Orbis launched the Orbis Global Balanced Fund, that this fund already had 74% of the money that has been invested in it in the Orbis Global Balanced Fund. So we thought, going forward, in order to make it simple and not confuse clients, let us change the name from the Allan Gray Orbis Global Fund of Funds to the Allan Gray Orbis Global Balanced Feeder Fund. And we wanted to make sure that this change is approved by clients, because again, it's clients' money that's invested here. This portfolio, though managed by us, they are the ultimate beneficial owners of all the assets in this portfolio. With that change also came an opportunity for us to have a look at whether we could slightly enhance the benchmark and have a look at whether or not the structure of the fund needed to change. And to answer your question, Kevin, the reason these things happen is also because they tend to have material implications on things like fees and the way that managers are incentivized. Now, I don't know about you, but I wouldn't want to know that someone to whom I'm paying a fee has just decided to change the fee without my knowledge.
Okay,
and
sure.
When it comes to, of course, right? And when it comes to service providers, similarly, when it comes to asset managers, you want to consult clients, you want to be as transparent as possible. And definitely, even in our case, we wanted to be transparent with the changes that were occurring. Yeah. So the process we would follow is once we decide on what we'd want to do, we'll communicate that with clients and then get their feedback in the form of a ballot. And similarly, to how we are going to vote on the 1st of November, you tally up the votes and you'll see how many people are for or against the proposed changes. And you'd make the changes based on how the voting outcome is. So that in a nutshell explains how some of these changes happen in terms of ballots, changes to mandates and objectives of funds.
Okay, we're not going to politics, but let's stick with investment. So when an investor receives such notification from the fund manager, what should the investor do? How should the investor respond, or can the investor just discard it, ignore it?
We would prefer investors to engage with this type of material because, as I mentioned earlier, some of these changes may have a material impact on how we as a manager are incentivized and the fees that the client is going to pay. And again, because we want to make things transparent and ensure that clients are aware of what is going on with the money that they've invested, we want them to engage with this material. Where an investor feels that they're overwhelmed, we are fortunate enough to have people like yourself, Kevin, that are independent advisors that clients can speak to get an objective opinion on what you as a professional in the investment industry think of the proposed changes and assist them in voting in a manner that is consistent with their values and with what they want to see with the money that they've invested.
Cedrick, finally, I'd like to find out, where does Allan Gray see opportunities as well as risk at the moment. I think that when everyone talk about investment, they always look for opportunity, growth, and making money. But we also need to be realistic. There are always risks abound. So where
Yes.
do you see opportunity and risk at the moment?
Sure, Kevin. I want to illustrate that point with just 2 slides. One is to give you an indication of the last 12 months up to the end of the 30th of September 2021 for the Allan Gray Balance Fund, it being one of our most popular funds and our flagship fund, how and where returns have come from. This multi-asset fund is a fund, as I mentioned earlier, that invests in a variety of different asset classes, and both locally and offshore. And it gives you an idea of where the recent returns have really come from. And although I must make the point, we don't focus on short-term returns. I said earlier on that the Allan Gray Balance Fund is really for long-term investors. I thought the slide would illustrate and answer your question perfectly, because it shows you that the shares we have invested in have been a huge contributor to the returns that we've experienced in this portfolio and that clients have experienced, even though the economic environment has made many clients scared to invest in shares. And many of them have driven and gone into cash or other safe havens such as bonds, even with their long-term money. But the reality and the facts show that shares are still contributors to return, and for long-term money, that shares are still where we find value in a portfolio like the Allan Gray Balance Fund. And then to illustrate the point again, to also then touch on the point you made around also risks, I thought I would also share with you for the Allan Gray Balance Fund for the same period, what some of the contributors and detractors have been of performance in our shares. And this shows you that we don't have a crystal ball sitting in a room somewhere that is able to tell the future. We follow an investment philosophy and we stay disciplined. That doesn't always mean we'll get things right. Sometimes we'll invest in companies where the short-term results are negative and detract from relative performance. But we hope to get the majority of our decisions right so that we can create long-term wealth for clients. So as you'll see on the left-hand side, the contributors, the top 5 contributors to the Allan Gray Balance Fund's performance over the last 12 months to the 30th of September have been Glencore, Sasol, Woolworths, Old Mutual, and Nedbank Group. And for the benefit of the viewers, I'll talk a little bit about just 3 of them. Glencore is an Anglo-Swiss multinational commodity trading and mining company. And we like it because of its diversified business. Not only does it get involved in mining, but it also has a marketing and trading of commodities department, which is quite attractive, and many investors seem to overlook. We're familiar with Woolworths. I don't know if it's one of your favorites, Kevin. It's definitely one of mine.
Yeah.
But it's a retail company. And what most people also don't know, I guess most investors who are not involved in the investment management industry, is that Woolworths is not just South African. It's a South African multinational that has stores in South Africa, but it also has investments in Australia, and specifically one of the Australian retailers, David Jones, and the Country Road Group. And we tend to like Woolies also because it trades at a discount to its intrinsic value. And we find that there is value in there that has created, as you can see from this specific slide, there's value that's been created for our clients over the short term. And then lastly, Process is one of the detractors. So let's not, let me not talk about the things that we will always get right, but Process recently has been a detractor to performance. And Process is a Dutch multinational conglomerate, and it was obviously born out of the South African multinational Naspers. But the Global Investment Group is one of the largest consumer internet companies in Europe and one of the largest technology investment companies in the world. And to really explain why we would invest in these companies, even though they've detracted from value, is we still see value because the intrinsic value of these companies is trading and is at a value where we can get the shares for much cheaper than what the company is actually worth. And over time, when investor sentiment changes and the growth prospects that we foresee in these companies in the future starts to come up, we are then able to sell these shares at a profit. And that's how we create wealth for our clients over the long term.
Okay. Just let's touch on like China, because Process, the largest investment there is Tencent. And there's been lots of problems or troubles going on with China, from the regulatory crackdown on certain sectors to more recent the China-America tensions, as well as power outages. So South Africa is not the only country with the power outages, but China also now suffering with the power outages. Is Allan Gray seeing value in China at the moment, or you feel there's a lot of risks that you would rather be cautious?
For the Allan Gray local portfolios, we have our investment partner, Orbis, that handles all our investments outside of South Africa, and they certainly see value in China. We've been investors in China, not from yesterday. So a lot of the things that are happening now don't make us nervous because we've seen the Chinese economy through different cycles. Regulations are always hard to predict. And for the investment team at Orbis, when they look at China, that's not what they're trying to do. They're trying to find businesses that are trading at low valuations. They're trying to find businesses that they think have a future in the Chinese economy, irregardless of how regulations could go, because you can't forecast those kinds of things. What you can do is look intently into a business, look into their financials, look into the competitive environment, look at what it is that they provide to consumers and how they're positioned, and then see whether or not that is commensurate with the value that they're being assigned by the market in the form of their share price. And if you see a disparity in that, which we're currently seeing in China, there's been a lot of sentiment that has been negative. A lot of investors thinking that China isn't going to grow, or China is very uncertain. The reality of it is sometimes these news it's overly pessimistic, and that provides buying opportunities, because even though you may revalue what you think the intrinsic value of a Chinese internet company may be, you also have to look at what that revaluation is relative to the share price. And in the wake of the news around China and the regulations and the power outages and the negative news, we saw an opportunity actually to invest in companies where the share price was phenomenally cheaper than what the intrinsic value of the business actually is. So that's how we think about investments. And that's what I'll say about China and the opportunities that Orbis is finding there that also impacts on local portfolios in South Africa.
Great. Cedrick, I hope your Chinese investment will bear fruits for investors for the years to come. Thanks very much for your insight. Until next time. Bye.
Thank you very much, Kevin. Thanks for having me. Cheers.
Thanks for watching. Thumbs up if you like this episode and share it with your friends.